Hi, this is Ron Cipcic, and this is the second part of a four-part series on labor market theory. In this particular segment, we're going to derive the labor market supply curve and the labor market demand curve. We're going to show you the foundations, and then once we get the labor market supply curve and demand curve in place, we'll begin to use that model to talk about how changes in supply and demand affect wage rates and employment levels. It's important to remember that in labor market theory, the supplier is actually a member of a household. We showed that in lesson 1 that households are actually suppliers of labor. So when we look at a labor market supply curve, if we want to understand the foundations of a labor market supply curve, we need to begin with the individual worker. So let's say we have a worker here. Her name is Kara. And Kara is a gadget worker. She works for a gadget company making and selling gadgets. And Kara, like most workers, is motivated by wages. Okay, most workers work because they want to earn pay. And the wage rate is we'll assume in Kara's case, it's an hourly wage that motivates her to work. Let's say that at a wage rate of, let's say at a wage rate of $9 an hour, Kara is willing to work as many as 30 hours a week. So Kara's a young lady. She's graduated from high school. She's attending college. She has to pay some of her own bills. And so at $9 an hour working for a gadget making and selling firm, she's willing to work 30 hours a week. So she works a little bit more than part-time and not quite as much as full-time, and she kind of splits her time between school and work and other sorts of leisure activities. So at a wage rate of 9, she's willing to work 30 hours per week. So labor supplied here is in hours per week. Okay? And then this is the wage rate, and this is the wage per hour. Okay? Now, let's say that her company, who sees that she has great promise, would like to get her to commit more to working and less to going to school and doing other things. So say that this company is willing to boost her pay to $15 an hour, but would expect that she would work, let's say, 45 hours a week. So she'd be working really more than full-time hours, 40 hours per week. So Kara is willing to do this. Let's say that if her pay were raised from $9 an hour to $15 an hour, she would be willing to go from 30 hours a week to 45 hours a week. In other words, she's demonstrating the law of supply. If you pay her more, she'll work more. This, by the way, is very similar to the profit motive. Businesses will produce more if they earn more profit on a particular activity. They will not produce as much if they don't earn as much on that activity. So what happened here is the wage rate that Kara's paid increases from W1 to W2, 9 to 15, and her labor supplied increases from 30 hours a week to 45 hours a week. So her labor supplied increases. And as I said earlier, this is the law of supply. In fact, we can actually write this out. Let me go ahead and do this. I've not left myself enough space, but I think we can wiggle it in here. So an increase in wages leads to what? Leads to an increase in labor supply. This is the law of supply, but it's the law of supply applied to a labor market. In this particular case, a particular worker within the labor market. Lower wages motivate Kara to work less per week. Now, in basic labor market theory, the world breaks up into two types of activities. We're either working or engaging in leisure. And when we ask somebody to work more hours per week, we're actually asking them to play less or to engage in less leisure. As we use up more and more leisure, that leisure we're cutting into becomes increasingly valuable. And that's exactly what we see happening here. To get Kara to devote another 15 hours of her leisure, which she devotes to school and to things like eating and sleeping and hanging out with her friends, to get her to give up 15 more hours of leisure, in other words, to get her to work 15 more hours, she's got to be bribed. And the bribe is a wage rate. Okay? Now note here that this supply curve is lowercase. This is a lowercase, small s, indicating that this is the supply curve for an individual worker. We can take all of the gadget workers. We could take Kara and Bill and Tom and Sarah and all of the gadget workers in a particular area, and we could combine their supply curves and get what we call a market supply curve. Now this supply curve is uppercase, this is capitalized, and this is the sum of all of the little s's. In other words, if you take Kara's supply curve and add it to all of the other gadget workers, you're going to get a market supply curve. So this is the market supply curve for gadget workers. This includes Kara's supply curve and all the other workers who do gadget working in this particular area. What do we see? We see the same thing. At relatively low wages, there's relatively low labor supplied. At relatively high wages, people are willing to supply more labor. And again, this is the law of supply. It is the law of supply applied to the supply of labor. Okay? Now, the steepness or the flatness of the supply curve for a particular worker, how far that supply curve is to the left or to the right, that depends on a lot of factors. You know, some people are more work averse. When people are more work averse, their supply curve is going to be further to the left and going to be steeper. In other words, you have to bribe them with higher wages, and when you bribe them with higher wages, you don't get a lot more work. Some people tend to be more workaholics, and so you don't have to pay them as much to get them to work a lot. Their supply curves are not only over to the right, but they're relatively flat. So small wage increases get them to work a lot more. So the point is, a particular individual's supply curve is going to be shaped by a lot of factors. We do not have the time at the principles level to go into all those different factors. But just know that different people have different supply curves, and each of their supply curves have a different shape depending on their preference for work and leisure. Okay? Now what we would like to do is we'd like to move on and begin to talk about the demand side. So there's the supply side, and I'll put a line across there. And now we want to go down to the demand side of the model. Where does the demand curve for labor come from? And we indicated in lesson 1 that the business sector is the primary demander of labor. So in labor market theory, the business sector is the demander. All right? So this is data for a hypothetical company. Let's just say that this is, I'll call this ABC company, and ABC company employs a particular type of labor, say gadget workers or fidget workers or widget workers or whomever. So ABC company is an employer. And an employer, remember what an employer is. An employer is a demander of labor. So you have to kind of reorient your thinking. Now, we want to look at the foundations for where this demand curve comes from. So ABC company hires these particular types of workers. We are going to assume that all of the workers that ABC might hire meet a minimum qualification. So what we're assuming is all of the workers here are of equal quality. All right? There's no difference in the quality of each of these workers. They're all equally trained, they're all equally motivated, They're all equally drug-free, they're all equally sober, they're all equally happily married or unhappily married, whatever the case might be. The point is, these workers are of equal quality. So all 6 workers have identical marginal productivity in terms of their quality. Their quality is equal. However, notice that as you add workers, the total product of those workers increases at a decreasing rate. So notice this. 1 worker can produce 1,000, 2 1,900, 3 2,700, and so on. Total product is increasing, but increasing at a decreasing rate. Now remember, we talked about this in an earlier lesson. Total product is Q. It's quantity. It's the cumulative output. So as we add workers to what? We add workers to a fixed plant size, which means we're talking short run here. We're talking short run analysis because the plant size is being held constant in the short run. So if we hold the plant size constant and we're adding workers to a fixed plant size, what we're seeing here is the law of diminishing returns setting in. Total product is increasing, but increasing at a decreasing rate, which means, notice, marginal product is declining. So this decline in marginal product has nothing to do with the quality of the workers. The quality of the workers is equal. What we're assuming is the plant size is fixed, which means the plant is becoming increasingly crowded, the room is getting crowded, and each additional worker is adding less and less and less output to the total product of the outcome. Okay? And if you remember, this is called the law of diminishing returns. This is the law of diminishing returns. And it's just the idea that marginal product falls as you add a variable input to a fixed plant size. I like to call it the crowded room theory. There's just not enough capital to go around as you keep adding workers to a fixed plant size. Okay? So that's being assumed here. This is a very important consideration. We have diminishing marginal product, which is the law of diminishing returns. Now notice as we go left to right on this table, we have a column over here for the price. This is the price of the final output. This is not the wage rate. This is the price of what the product is being sold for. Notice that the price does not change as we produce more. So whether the firm produces 1,000 units or 4.5 times that, 4,500 units, the price of the product doesn't change, which means this firm is a price, we're assuming that this firm is a price taker. We're assuming that this is a purely competitive output market. If you recall, now this takes us back a ways, but if we're talking about a purely competitive output market, this is what it looks like. So here's ABC Company, and I'm looking at the product side now. Here's the firm. This is ABC. And remember, if it's a purely competitive firm, the demand curve is what? The demand curve is horizontal. So here's the price. The price equals 2. Where does that price come from? That price comes from the market. The market determines that price. The firm is what we call a price taker. If the firm is a price taker, it has no control over price. So the market affects the firm, but the firm cannot affect the market. We learned in an earlier lesson that means the demand curve is perfectly elastic and price equals MR. So if the price is 2, the marginal revenue has to be 2. Okay? So this is a very important idea here. We're assuming that the firm has no price-making ability. So whether the firm makes 1,000 units or whether the firm makes 4,500 units, it doesn't matter. The firm can increase its output rate and that has no impact on price. Remember, the firm is very, very small when compared to the overall market. So again, the market affects the firm, but the firm does not affect the market. Okay? So that's why we see in this table that the price doesn't change. Whether we're producing 1,000 units or whether we're producing 4,500 units, the price remains at $2. Now, the new concept we want to introduce at this point is something called VMP. So let me go ahead. I'm going to go down below. I didn't leave myself room up above. So what is VMP? It's the value of marginal product. How do you calculate it? Its value of marginal product is equal to what? It's equal to the price times marginal product. So basically, we're now putting a dollar value, on workers. You go, oh, come on, companies don't do that. Yes, they do. I'm going to take you to a place that is going to lead us to this conclusion, that basically companies only want to hire workers if they believe that the value of the worker is greater than the cost of the worker. Now you can poo-poo this idea all day. You can say, I don't believe this is the way the world works. I don't want to believe that people put a dollar value on people. But you can wish it were different, but companies make estimates of what a worker is worth to them. And if a worker doesn't generate enough value to cover that worker's cost, then the company is not inclined to hire that worker. And by the way, this not only applies to profit organizations, it applies to nonprofit organizations. I work for a community college. Community colleges have to be profitable. You go, well, they're nonprofit, but they still have to be profitable to survive. They do not have shareholders. Shareholders do not receive dividends and payments. But the point is, the community college has to be profitable. Its revenues have to exceed its costs, or it cannot stay in business over the long run. All right? And colleges are very interested in trying to conserve their resources. Their resources are very scarce. If an instructor is not generating enough credit hours to cover that instructor's cost, then the college is not inclined to continue that program or to continue to hire that instructor. So if you take credit hours generated by what the college generates on a credit hour in terms of revenue, what the price is per credit hour, which would not only include what students pay, but what is received from the state or from local taxpayers. But if an instructor does not generate more revenue than what they cost, then the college is inclined to not hire that employee. And these kinds of calculations are done all of the time, both in profit-making situations and in non-profit-making situations. So I hate to pop your bubble, but this is what the real world is like. So what does the first worker add to the value of the firm? What does the first worker generate? Well, 2 times 1,000 is plus 2,000. So the first worker is worth $2,000. Second worker is worth $1,800. And you can see the pattern here. Plus 1,600, plus 1,400, plus 1,200, and so on, plus 1,000. So every one of these workers adds value to the firm. But notice that value is declining due to the law of diminishing returns. And again, this has nothing to do with worker quality. The sixth worker, whoever that is, Fred, we're not saying Fred is half as productive as Mary, the first worker. Mary adds, she's the first worker added, she adds 1,000 units. Fred only adds 500 units. We're not saying he's half a productive person. What we're saying is 6 people can only make 500 more than 5 people. 5 people can only make 600 more than 4 people. 4 people can make 700 more than 3 people. So marginal product is looking at what a group of people can produce more than a lesser group in terms of numbers. So 6 workers can only make 500 more than 5 workers. 5 workers all working equally hard can only make 600 more than 4 workers, and so on. Okay? So this VMP is primarily affected by the marginal productivity of the labor. And that makes sense. The demand for labor is derived from the productivity of those workers. In other words, I don't need gadget workers if they can't produce gadgets. All right? My desire as a gadget company, ABC company as a gadget company, is desirous of gadget workers only because those gadget workers produce gadgets. And if they're not producing gadgets or producing a sufficient number of gadgets, then we're not going to be as inclined to hire that worker. So marginal productivity is a key factor that affects the demand for labor. Now, let's take this a step further. Let's assume that these workers are being paid, let's say they're being paid $1,200 a week, which would be very first world for manufacturing, or it could be $1,200 a month, which might be more third world. Well, let's say $1,200 a year. That would be definitely third world. The point is, whatever the rate is, however long we're talking about, be it a week, be it a month, be it a year, let's say the wage rate is $1,200. So let me just go ahead and write this in here. The wage, let's say the wage equals $1,200. So whether we're talking weekly, monthly, annually, the first worker pays. $1,200 is less than $2,000, or $2,000 is more than $1,200. $1,800, second worker adds $1,800 of value, only costs us $1,200. The third worker pays. Fourth worker pays. Fifth, we break even on the fifth worker. Fifth worker brings in $1,200 but costs us $1,200 if we're ABC company. Would we want to hire the sixth worker? Absolutely not. Why? Because the sixth worker only brings us in $1,000 of value, and that worker costs us $1,200. So you only want to hire a worker if the value of that worker is greater than the cost of that worker. Now look at this. This is W1. Let's say wage rate 1. Say that these workers organize. Let's say that they unionize, and now they collectively bargain, and they're able, through a negotiation process of collective bargaining, they're able to push the wage rate up to, say, $1,600 a week or a month or a year, whatever it might be. So say the new wage rate is W2 is now equal to $1,600. So the wage rate has been pushed up to $1,600. Notice there's no change in marginal productivity, and let's say that the company cannot pass the higher wage on in the way of higher prices. So we're going to hold prices and marginal productivity constant. What's going to happen? Well, the firm, again, is going to be willing to hire the first worker, the second worker, and the third worker, but the fourth worker and the fifth worker will no longer be profitable. So the fourth worker and the fifth worker would be laid off. So if we force a higher wage onto the firm, and the firm is not able to pass those higher costs on in the way of higher prices, and let's say the higher pay does not affect the marginal productivity of the labor, then you're asking the firm to actually employ fewer workers. Here's another possible scenario. Say that the government imposes a minimum wage of $1,600 a week, or $1,600 a month, or $1,600 a year. Say that the government imposes a wage that has nothing to do with the marginal productivity and price of the final product. It just is imposed by the government on the firm. Well, again, this firm, if this firm cannot pass on the costs in the way of higher prices, and if this firm cannot somehow get higher marginal productivity out of the workers, then this firm is going to be forced to lay off workers 4 and 5. All right? We're now getting close to talking about the demand curve for labor. So let's go ahead and move down, and I'm going to pull these principles together and draw the big conclusion. Here we go. I'm going to come down here and we'll go green. And here's the VMP curve. This is the VMP curve. So if you plot VMP against L in this case would be workers. As you increase the number of workers, as you increase L, what happens? VMP decreases. And we saw that in our table. Now, at very, very low wage rates, at a very low wage rate, say the wage rate is equal to $1,200 a month, at a low wage rate, the firm is willing to employ how many workers? 5 workers. That's what our table up above said. So, excuse me, that's getting messy. I get to use my eraser. I love it when I can use my eraser. Okay, so at a wage rate of $1,200, our table up above said that this firm would employ 5 workers. This is labor demanded, LD1. But if the wage rate is increased up to $1,600, the firm only wants to hire how many workers? The firm only wants to hire 3 workers. LD decreases. We go from LD1 to LD2. So as the wage rate increases, labor demanded decreases. This, in effect, this VMP curve is in effect the firm's demand curve for what? For labor. So the VMP curve is the firm's demand